All right, so we had two events this week that we were kind of looking forward to for the last couple of weeks, and that was the Nvidia earnings. It was the last big Magnificent Seven company really to release its earnings, and then you had, the Jackson Hole event. That's been widely anticipated. We got through the Nvidia earnings, kind of hit us a little hard. We started off very positive Wednesday night, going into early Thursday morning. By the time the market opened, we lost a lot of those pre-market gains, and then we just lost the rest of it and then some during the market yesterday. Today we went into Jackson Hole with a little bit of a bearish bias, came out of it with a little bit of a relief, kind of like an exhale. So now we've got those two things behind us. We have jobs and September inflation, and now the question is, as it has been now for the rest of this week, but now that we got these two big events behind us, now is this intermediate decline done? Or is it going to turn into a deeper decline that would be the, beginning stages of a correction? The catalyst, we kind of thought Nvidia would be a catalyst, and there's some technical signs that suggest that, with a catalyst, we could really break out and end this intermediate run and be done. There's a lot of other signs that suggest that how weak this intermediate decline has been, that it's very unlikely that we're done, especially now that we're lacking the two really positive things, a dovish Fed and a strong Nvidia that could really rally us. So lacking those two things going into what may be some weaker September or August jobs data, and especially expected to be a strong inflation report in September, with yields staying higher, the expectation is, and I'm going to show you kind of why the expectation is that we might be beginning more of a pullback that is, that suggests that we're going to have more of a correction by the time it's all said and done. So I'm going to talk about that in today's video. We'll see just how broad this weakness has been from a global standpoint and within the U.S. markets themselves. And then our trade idea is a stock that's set up for a significant decline if we do go from this really lack of complacency stage to more risk aversion. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, August the 25th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including the Market Outlook live video that I do on Friday, or Monday, Wednesday, and Fridays at 3:30 Eastern Time before the market closes. Come down here to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Hit that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask. So thank you, those of you who do this. Our goal is to get to 100. We get really close. So thank you again. Those who do that day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we did rally to finish off the day, but because of yesterday's big decline, it actually brought the near-term line down into bearish territory, avoided the reversal zone for now. We were actually a little bit below that at the lows of the day today. But we are that's a pretty bearish near-term peak to get in the bullish territory, but not get in the upper reversal zone. Obviously, it's a much lower high point than the last time. You could look over here, would be the last near-term peak that we had, much lower than that one. So you expect now the next near-term low point to get down and below this low, below this last one. So we'll see. The momentum line did get to extreme lows, again suggesting that the near-term line has a good chance of dropping to those strong low points as well. Doesn't always mean it has to. Things can change pretty dramatically, of course, in the short term, but your momentum line still not very strong, and you kind of need to see that momentum line really spike up here to break out of this malaise that we've been in. With your intermediate line down, it's rising. That's why you have the light green shading. It is rising, but still very low, below the 25th percentile, and like I said, long-term market sentiment's falling there. You're still nearly 2% below the moving average. Very similar pattern On the NASDAQ 100, its near-term line's a little bit lower. It's kind of flirting there with getting below the 20th percentile, but still, red line and light green shading. Your Russell 2000's been the lowest below the moving average, down 4%. It's been pretty bearish. Also produced a pretty bearish near-term peak, a lot lower near-term peak than the last one that we had. And again, intermediate line is actually in the reversal zone, so flirting with clusters there. And then finally, your Dow Jones Industrial Average has also got, finally, its intermediate line down in the reversal zone. The near-term line never did get in bullish territory here. So it's actually still bearish. It's been catching down to where everything else has been here lately. And now you have the dark pink shading and the red line. The moving average is finally turned down. So you have the red line there. So things are looking pretty south for these. They're all pretty much looking almost exactly the same. When you look at their weekly chart, you can see just how bearish this the last couple of weeks going into this week was. We ended up higher this week, slightly higher because of that nice little rally. And that brought the short-term lines out of the reversal zone after being down there for multiple weeks. The momentum line was down there for 3 weeks. That's not very common unless you are, in bearish mode. Usually, when you're bullish, it goes down there for maybe 1, maybe 2 before bouncing back out. So we were down for 3 and is barely out. And the near-term line, of course, it was down for 2. And again, it's pretty rare for it to be down for more than just 1 week unless you're in bearish mode. So you are still easily above the moving average, the 30-week moving average. But that short-term sentiment getting down as low as it did suggests that, there's a good chance you can see when you get it down there for multiple weeks like this, it suggests that we're not going to maintain this bullish trend with that intermediate line as high as it is. It's obviously still well above market sentiment, so we're not threatening changing the trend at any point. It has to get below. When the market sentiment is this low, you have to get below it to change the trend. So we're not threatening that at any point here, but it is looking. The short-term sentiment suggests that this is probably going to be a little bit more bearish than what we've seen in the past. Same thing. You're still 8% above the 30-week moving average, and you are flirting with that 23% retracement level, and you're still above in the upper reversal zone, as you can see there on the NASDAQ 100. Of course, on the flip side, we got a bull tag, semi-bull tag. It would be a bull tag if the yellow line's actually rising, the yellow line's actually falling. We finished above it, and that's why we have the yellow line there. The yellow line's falling. If it was still rising and we closed below it, then we'd have our bull tag. But that's essentially what that pattern is here. Intermediate line, again, rolling over pretty easily without getting into the reversal zone for the second time. So the Russell 2000 is having a hard time really getting going. Bearish short-term sentiment. Like I said, you're only 0.25% above, and that's how close you were to getting a bull tag. Actually would have been a red line had we closed below, but the pattern still is pretty much that same idea. Light pink shading, yellow line. That combination tends to signal the beginning. Typically signals the beginning stages of a reversal pattern. Finally, your Dow Jones, which has been kind of more bullish here recently. That little breakout that we had in the middle of July to end of July with the cluster may very well turn out to be a fake out, as we've now completely reversed that move. That was a pretty good move because we had broken above a lot of highs. It was the highest close since way over into November 2021. That was the last time we closed as high as we did here. Actually, the second right there was the second week in 2022. It was the last time we closed as high as we did there. And then now we're back down. Right now we're back down, and we'll see if this ends up just being a retest. And we haven't necessarily broken back down significantly here, so it still could turn into a return move and a bounce back up. And we'll see. The near-term line's dropping down to the reversal zone. The intermediate line is dropping and about to turn pink. So we'll see if the idea is with how bearish that near-term line is and how long, and the fact that we didn't stay up there for very long, especially after the cluster, that would suggest that we're probably not going to turn. This probably is going to turn into a fake out. It's not going to be a return move and a bounce back up to the upside. Let's take a look at a couple other weekly charts here. So again, we've got the red arrow last week. We got the lower close. It's a higher low, so let's keep our eyes next week to see if we do get a Hakinyashi close. As of right now, looks like we're going to open right around 44.30, and we're at 44.05 right now. The Hakinyashi close here is right around 4,400. So if we close below 4,400 by this week, or trade a good portion of time below that, then we'll end up with a lower close and filling in this gap here. So really important to watch there as the Hakinyashi differential is crossed above its moving average just barely. If that a small candle, even if it's a small negative candle, can turn this back around and potentially get it going back up to the upside and potentially get a green arrow again. And you'd feel pretty good about the reversal in that case. We do have a green arrow on the S&P and the NASDAQ. We do not on the other two. Remember, they relate to the party, so there's still 3 red arrows. And, you got to get 3 green arrows to kind of start the new bullish trend and keep it there. So, again, we're not quite there yet. We're easily below these moving averages. So, we haven't turned things around yet. Every time the market goes up, I get a lot of comments that, see, the market is bullish, and one day doesn't change the trend. Even if it's the last time I got a lot of those comments was when Nvidia rallied up to 520 in the after hours, and I got a lot of comments about how not bearish we were, only to have the stock market drop way down, including and Nvidia dropping the last 2 days. Now the S&P MACD is still below its moving average, and you had a decent amount of volume there, but stochastics is still in bearish territory, and we're still easily below the 17-day and well below the 50, right? So as long as you're below the 50, the threat of filling in that gap is there, especially when there's not very much volume to begin with. You can see the Qs, the same thing, and remember the diamonds are the ones that kind of came late to the party here. And you can see they are also now below the 50-day, with the 8 and 17 crossing below. The MACD is negative. Very strong support at the 200-day moving average, and not nearly as big of a gap between the 50 and the 200 as you see on some of the other indexes. Here's IWM, has filled in the gap between the 50 and the 200, sitting on the 200 now, with the potential of a breakout could get you down towards these old lows, and obviously that would be bearish for pretty much most everything else as well. Now let's take a look at one more weekly chart I wanted to take a look at, actually, and that's the Hull. Again, you can see that we have just barely turned south on the Hull 20-week Hull moving average, and you can see, when you get in a bullish trend, you can flip the parabolic SAR for a week, maybe a couple, but the Hull can stay bullish here when you're really bullish, like we were in 2021, and you can see in some of these other weeks, and you get these small intermediate declines that can turn around pretty quickly and flip that SAR. So it's really important. You can see that SAR right now is at 450s. We'd have to get up into that area. It's going to come down a little bit. The difference now between some of these other moves is that this is a pretty decently bearish candle that we had that typically leads to more weakness, as you see here, and we'll see if that. On 1 week, it hasn't turned it around yet, but 1 week and one more week we can turn it up. The other big difference here too is, where the MACD is below its moving average, which for the first time in a while, right, since it's been bearish. Brief little periods of turning down, but much lower levels. The moving average actually rising. The moving average now is starting to roll over and fall down. So we have an opportunity to at least start converging towards that 200-week moving average, even if we don't necessarily plummet towards it like everybody thinks that you might think we would if we're bearish, right? That's not how necessarily it always works. The DMI is still kind of neutral. Neither one of these lines are above 25. The negative line's the closest. The positive line is down well below 20, so a little bit of a bearish bias because of that. The RSI and the CCI also in bearish levels, below 50, below 0, so pretty bearish bias from that perspective too. You can say now that we've started a bearish trend here with this drop below 50 and now getting below 40. You could probably pull it back out over here when we first dropped below 50. that ultimately got down there below 40. We also dropped below minus 100, and now have stayed below zero for quite a while on the CCI. So this is quite an extended period of time of not getting bullish at all on the CCI. So again, bearish slant there. The green line still below the blue. The price is still below the blue. Negative rate of change has gone pretty negative. Intermediate trend strength to the downside. That's starting to develop on the diamonds as well. You can see the diamonds has got a weak bearish trend. You are in the cloud. You're about to get the crossover. So it's one of those stages here that, the cubes have got the crossover. So we either kind of bounce back up here now that we've crossed over, or at least we need to bounce back up by the time we get there and turn around. But usually by the time you get this crossover here, it's not very long before we bounce back up if we're going to stay bullish on there. So really interesting pattern developing on the Ichimoku cloud with these major indexes. You are back out of the lowest quartile. You were barely in it to begin with. We're still in the lower half of the Bollinger Bandwidth, though. That's now starting to fall back down. Bands, you can see the momentum is turning back up here. So the negative momentum is waning. So that's something to keep an eye. If we get back into the upper half of the bandwidth at least, then we can really start to put some pressure on that negative momentum and get those bands inside the Keltner channel and potentially turn the trend around. So you can see there's some signs that we may be ending. We kind of thought that NVIDIA, if we were going to end the intermediate decline right now, that NVIDIA would be the catalyst for that happening. Obviously that wasn't the case. So that's why I think it's still less likely that we are ending the intermediate decline right now. We did close above yesterday's low. It was a lower high and a lower low. So we need to kind of flip that around. Ideally, we get some kind of really strong gap higher. We talked about that today in our Q&A session. If we can start off Monday with we've gapped up the last 5 days, but only 3 of those days were bullish. So if we can get a gap up of a little bit stronger than what we've seen, kind of up in this 1 standard deviation or higher, and then finish well above 1% and get a good runaway gap going, then I feel really good about the fact that we're ending. The stage was set for that to happen Thursday morning, and by the time we got to the open, we had lost a lot of that bullishness, and then of course we ended up not running away from the open and dropping down pretty significantly. So we'll see if that's kind of what you'd like to see. And we have the red line is going to be below 70 in another day or two. The green line's already hit 0, so we're already at the conditions that we need to get a bounce up off of the intermediate low point. So again, the signs are there. This needs a catalyst, and we had one catalyst. Maybe the Jackson Hole might be the catalyst too, that ultimately bounces back up. Yields falling, I think, would be a major catalyst if yields were to fall, and that's the problem. That's why I don't think we're going to get the bounce back or the end of this decline. Is because I don't think yields are going to fall. I think they're going to remain towards the upside. Today's range and volume was pretty steady. We were above average on the volume, above average on the range. We're well above 1% now. The last time we were below 1%. And then crossed back up above 1% was back here in November, and then we stayed above 1% the whole entire time. Even with the new high point in 2022, we stayed above the 1%. Eventually, got above the 1.5% mark, and away we went. So we've been above 1% now for about a week or so, a little bit more than a week, and we haven't started to drop back down yet. So keep an eye on the volume rising and the ATR being as bullish again as. Signs that, again, we might be a little bit more bearish still to come before this thing ends. The other thing that really stands out to me is that really low VVIX. The VVIX dropping as low as it is. The actual correlation with the VVIX and the VIX below the 50% mark, which usually signals a bullish bounce in both of these. And then finally the VIX itself well below 90%, and still, and for that matter also, well below its moving averages here, below the 17-day moving average. Big drop. So, and the MACD is below its moving average there. and the stochastics is trying to drop back into the lower half of the chart for the first time. So, I mean, if this can change, again, signs that we might be reversing. The problem is you would like to have seen this pattern occur above the 200-day moving average. You'd like to see this pattern occur above 95% on this chart up here. You'd like to see this pattern occur up here, ideally above 100%. But the fact that it's barely above 90 and we're back below 90 and the VVIX is so low, again, suggests that there may be some more bearishness to come, that we're just way too complacent already to be signaling, to be ending this intermediate decline with, even with a lot of these signals that suggest we may be ending it. We just haven't been bearish enough, broadly speaking, despite, the McClellan oscillator. Like, you look at the McClellan oscillator and you get this 6 days in a row below 70, and you would think that we were like full-on correction, like pretty significant pullback mode here, and you're still below the minus 35 mark, even with the rally. But despite that, despite the breadth being as bad as it is, and the 50-day moving average knocking on that 30%, the number of stocks above the 50-day knocking on that 30% door, the number of stocks above the 200-day moving average knocking on that 50% door, which, crossing through that threshold usually signals correction. We need to have this ends up being an intermediate pullback. We don't even have a 5% tag here. It'd be a very, very weak intermediate decline that, again, would suggest that, that there's probably more to come. That I think a lot of people are hopeful this is the end of it, but a lot of people that are hopeful that this is the end don't necessarily pay attention to precedent, in terms of just how complacent that we've been. And there hasn't been enough of a sentiment change to give us a new low point to get a new 19% tag or 10% tag or 17% tag to come off of this low point. So if we do come off of it, we'll probably just barely get above these highs and then really get more of a tag that's a lot more uncomfortable than if we had just gotten a 5% tag here and made our run, a 10% run up to that 4,800 level, which I think we're all kind of hoping that we can get. All right, now let's take a look at the different asset classes and how they're performing. Look at commodities. Look at the run commodities had over the past 3 months. They've been the strongest performing, hence the rising inflation expectations that we've been seeing. In fact, when you look at inflation numbers here, let's look at the inflation nowcast from the Cleveland Fed. You'll notice that it's still very, very high for the September release of the August numbers. That's going to be coming up next. In fact, I think that comes out before the Fed FOMC meets there in September. In the year-over-year expected. And remember, it dipped its toe under 3%, just barely, like that. Its toenail, it dipped under 3%. And now already in two releases expected to get a lot closer to 4%. So you see how, again, this idea, and that's kind of what I had up here, this idea that they have a good shot of attaining 2% inflation, according to the Fed's Loretta Mester, I believe, without doing damage to the real economy. That's never happened before. Not from this peak. Not from a peak this high. There's been lots of damage. Every time we've had a inflation get above 5%, except for back over here, you eventually did have, and again, you can see it sparked a 10-year period of 3 smaller recessions. But I mean that's pretty damaging to an economy there. So you can see we literally never have peaked with inflation this high and not done damage to the economy. So the fact that there's a good chance of that happening would be the first time it ever happened. So it's pretty ironic that she would say that. But and again, the fact that we're already starting to rise back up, especially with rising commodity prices and rising yields, as you see with TLT down at 3 months, suggests that that's how hard it is, right? And if you look at how things performed here this week, so if I go out to August and look at how the week performed here, let's go to like a 10-minute chart. And you can see the big winners on the week. S&P was up. The Qs were up huge early. They pulled back, almost got to 0% early Friday morning before rising. You can see bonds rallied too, so they had a big move. And gold benefiting as well. Interestingly enough, outpacing commodities, barely underperforming long-term treasury bonds, and definitely outpacing equities, right, except for the Qs, but outpacing IWM, who was down, and SPY and international equities. So, all of that performance, and that's with the dollar being bullish the last couple of days. Of course, gold coming off its highs, but still, that's a pretty decent return for gold, as you can see, kind of making a new run, a safe haven asset class, but making a little bit of a run here off of its 200-day moving average. So, because if it breaks this 200-day moving average, that's a pretty decent free fall for gold. If you look at the weekly chart, we are below the 30-week. This 8 and 17 now are below the 30-week, so we're not just kind of testing the 30-week and bouncing. We're kind of closing. The MACD is negative; it's below zero, and the point of control here on the 5-year charts at that 200-week moving average. There's not a whole lot below that, so you can see how bearish gold got when the dollar was rising and equity markets were bearish. It appears we're heading in a similar direction. You see that with the dollar index itself. I mean, look at that breakout after the again, similar to the Dow Jones. You get this breakdown. A lot of people talking about the dollar and it's going away and no more reserve currency. It always happens when the dollar has kind of a significant breakdown, despite the fact that even at that low point, that's still a lot higher for the dollar than it was. But it was below 100, which is kind of a par level for that particular index. But after that breakdown, slightly below 100, big bounce. 6 weeks in a row now, easily above the 30-week moving average, filling in the gap between the 30 and 50, and then no resistance above that. So if you can get above this 105 level, you really got, you can really start to make a run. Now, will it get back above to 115? I don't think so. But can it get up here and stay up here? And that's kind of what I'm expecting, and that would put pressure on equities, as it would be a benefit for yields. That's what happened over there. The dollar rallied, yields rallied, and now over this past 6 weeks, the dollar's been moving higher at the same time that yields have been moving higher, right? So the dollar dropped, yields dropped right there that week of July the 10th, and then the last 6 weeks, big move back up to a high of 4.36 before pulling back to 4.24. By the end of the week, but the MACD itself is clearly positive. Stochastic's well in the reversal zone, so the trend is clearly back to the upside and very strongly bullish. Look at that, how big that gap is between the 50 and the 200-week moving averages. If I go all the way out to all the data that we have ever had on the 10-year yield, this is the strongest gap that you've seen between that 50 and 200-week moving averages that we've seen. So big time gain, and at some point in time there's going to be a reversal there, and at some point in time that they would have a bullish move here on yields, right? TLT, bonds. I don't know if this will be a double bottom, end up being a double bottom or not. You'd like to get above like that 7-week, and but if you can see from that MACD perspective. Let's just go back to the normal time frame on that MACD. You can see that the MACD is still below its moving average, so Stochastics is still in the reversal zone. So 1 week change there doesn't change the trend. Let's get back above the 8-week. The point of control is really low on this chart. If you clear these levels, there's such a wide gap there that TLT can really make a run. A lot of this volume right here occurred 5 years ago. So as we get to the end of the year and into next year, a lot of this volume is going to be gone. None of this volume is going to be gone, and none of this volume is going to be gone. So you're going to have not only a big gap between the 50 and 200-week moving averages, but there's going to be a tremendous gap in volume. So once you clear this 106 level, which is a 23% retracement, then bonds can really take off, and it's not going to do that in a bullish environment for equities. It'll more than likely do that because we are more risk averse and headed towards a deeper correction again, and probably similar to what we saw in 2022, but this time coming off a much lower peak, right? Coming off of a much lower peak on the SPX, much lower gap, and easier to break below that 200-week moving average than what happened in 2022. Let's take a look at the global markets, the major markets here, and see if they're kind of matching what we're seeing And you can see it's a pretty decently global. I mean, developed markets, emerging markets are all pretty bearish right now. More bearish than what we're even seeing in the U.S., except for India. India is the one wild card. I said in my class that India is kind of like the NVIDIA right now of the global markets. It's kind of holding up, especially emerging markets, a little bit better. Italy is doing okay, but at 21, that's why it's light green. Brazil is at 26, but a little bit closer to the moving averages, but most everything is bearish to the downside. And then just looking at the U.S. sector charts by themselves, the S&P 500 sectors, you can see again light green shading and a red line though across the board up at the top, dark pink shading and a red line everywhere else. Again, energy is kind of like the NVIDIA of the S&P sectors, holding up a lot better than its peers. Healthcare is also doing a pretty decent job lately with a lot of those obesity drugs in the headlines. It's been holding up pretty well, but trading below its moving average. So you can see it's pretty broadly bearish. So again, another reason why we might be more bearish still to come. It's usually when you get these weak intermediate pullbacks, you usually don't have everything dropping. You usually have something holding up. I mean, not these small sectors, but something up here that's holding up. And for a while that was XOK because of NVIDIA this past week, but now we don't have that. And so that might be the lack of NVIDIA holding us up. NVIDIA might not push us up to end this intermediate run, but now the lack of it holding us up, as you can see, NVIDIA has really had, it had that down day on Thursday post its earnings, but then continued that decline on Friday. And you can look at that gap there. So once it starts to fill in that gap, like some of these, like its peers, like Marvell Technology, then you can see how easy it will be for things to get more bearish on a broader equity scale. Because of what's been, you can see, even looking at Apple, it's below, it's filling in that gap. Microsoft is filling in that gap. Amazon is also holding up pretty decently. Tesla also had been holding up this past week, but again, had already been filling in that gap. Meta, you can see it's starting to fill in that gap. And then Google, also kind of like NVIDIA, that AI trade still holding us up, but from filling in a pretty decent gap. So once you start losing that momentum from those AI trades, then I think we'll get the broader selling that will flush out the system on an intermediate level, not a bear market, not even a correction at least for now, but at least on an intermediate basis, flush out the sentiment needed to, like I said, start a 10% plus rally on an intermediate basis again. This pullback still hasn't been enough. It's still way too complacent to give us a good launching point for a new run. All right, our trade idea is on Adobe, and very similar to what we just saw with NVIDIA. Look at that big gap and no volume at all in this area because we moved up so fast. Even before earnings, we moved up so fast. But now it has earnings coming out again. And again, we talked about NVIDIA, and the problem with NVIDIA going into its earnings was its return on a 3-month basis was so strong. It's kind of hard to sustain such a strong move. And you don't have as much of a move here on a 3-month basis for Adobe as we've really kind of slowed down after its last earnings. Still at pretty decent level at 33%. That's still the stronger level than what we saw over here going into this earnings. Let's try this again. Going into this earnings, you were up 38%, and you can see just how slow things got, and we're at 33% now. But let's back this out to the last 6 months. So let's go in those last 2 earnings cycles, because a lot of that bullish rally there was after this last earnings result. And look at that, 63% rally going into earnings. I mean, kind of like what we saw over here. And then, we had such a strong run going into that earnings, and then look how sideways it got. This is even it's about the same in terms of the 6-month period, but you saw what that last 3 months has been. It's going to be very hard for Adobe to maintain a strong bullish trend, especially when you have such a wide gap there in those moving averages. Especially when you look at, again, like something like the Bollinger Bands here, the Bollinger Bands that have that had been so wide that have pulled way back inside their Keltner channels and are setting yourselves up. You had, the DMI was so extreme in its bullishness. The ADX getting above 50, the negative line getting way down here. Neither one of these are above 25, so you're looking for one of those to break out. Again, if you had to guess which one, you would guess the negative one because of how strong the previous bullish trend was. And then look how strong that bullish trend, got up to 14 and, way in the mid 90s. Very extreme bullish trend. And look how big that cloud is that you can fill in. So you've got opportunities here for Adobe to kind of correct some of this extreme bullishness that had. Here's the weekly chart, and look at how it got up with about 75, and then now you're starting to kind of slowly work your way down. In fact, when you look at like the whole moving average for Adobe, here's on the daily chart, you can see you're below the 200-day hole now, and the MACD has been below its moving average for a long time there. But if you look at the weekly hole, I mean, look at that thing, and that's how close we are to flipping this around. You've been below the 20-week hole for quite a while, and you got such a gap here. Very, very bullish, more bullish than what we've seen in the last 5 years at least. If you go out the last 20 years, it's the most bullish you've seen since way back over here in 2003, and we're in a much different environment now than we were then. Big old candles over here on the Hakinyashi candles. So the idea is that if we were to start to really reverse to the downside, we can fill in that gap pretty quickly. This gap here, we can fill in that gap pretty darn quickly, and you can see on the market forecast chart, we've been converging for so long, even on a weekly basis here. Try this again. On the weekly basis, look how big the gap is. 40%, 30% above the 30-week moving average. Very rapid move too. Not your typical grind up, and we had a nice little rally up that I want to kind of take advantage of to build in some flexibility for a pretty aggressive bearish trade. So I decided to come out to October to give myself some more time for this speculative trade to see if it can work out or not. And we're going to go out to that 20 delta. At least it was at the 20 delta when we did the Market Outlook Live Friday before the close. We're going to buy that, sell one strike away. You can see here's where we're at. A very small position, especially it's a 4-to-1 reward to risk ratio. With usually a 4-to-1 reward to risk ratio, you're right on the cusp. I've actually got some flexibility to work with. The stock can rally a little bit more, and I've got that much room to work with. So that's the benefit of taking advantage of this rally. It gives me a little bit of flexibility, but that's the potential reward. And not only has to get to 460, which you can see if we hit 460 by expiration, which is right here, it's going to be very easy to stay below 460 by the time October comes, because it needs to stay below 460 to get that $2,000 reward for what ultimately may be just a couple $100 of risk, because we're not going to take the full $500 of risk here. If we get up to 550, if we get up into this level here and start clearing these highs again, then we're going to easily be taking our small loss on this. So it's really about $2,000 with some flexibility for only just couple hundred bucks of risk. So really, really good reward to risk ratio. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.